Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 8 straight years and running, serving North Central Florida proactive savers and investors for more than 31 years. The team from GulfCoast Financial Services and founder and CEO John Kuykendall here with us, as always, providing guidance, insight, and a common sense approach to planning with our money, our investments for our financial and retirement future. And John, we do always appreciate that, because I think the world, especially as we are thinking about our money, needs a good dose of common sense. It seems to be lacking, far too uncommon.
Yeah, that's right, Peter. So a lot of people don't think about it. A lot of people don't plan for it. And a lot of people make the wrong decisions thinking they're doing the right thing. And so hopefully we can shine some light on some common sense things that they need to do and we need to plan for. And as you know, today's topic is going to be taxes. And that's something we've been harping on now for quite a while. And something here at GulfCoast Financial that we do a lot of tax planning. In fact, I met with our tax person this morning, and we were working on doing a couple of Roth conversions for a couple of our clients. As we got through doing their taxes, we saw an opportunity.
Well, speaking of doing the wrong things, I wonder if you would classify this into that category, or maybe some other category here. This generation, John, by and large, entering into retirement, has deferred and delayed paying taxes on the majority of their retirement nest egg. Were we doing the right thing or the wrong thing, or how would you classify that?
Well, I think, hindsight's 20/20, Peter, and this generation was the first generation to really get away from the defined benefit plan, the pension plans, and start the 401ks and the IRAs and the deferral. So we were taught that if we deferred during our retirement and saved, that we would have a nest egg at retirement, but it would be better because we would be at a lower tax bracket, and therefore the money we pulled out, we would be paying less tax on. But, that's not the case, Peter. What we're finding is that even with taxes at historically low rates, all of us that are old are paying a lot of taxes, and our taxes now are not any less than they were when we were working.
So is now the time to sort of rethink the way that we are planning and preparing and saving for the future, John? Even if we're already in retirement?
Yeah, I think we have to, Peter, because even if we're in retirement, we need to do it. Because as you know, that the tax cuts that President Trump put into place sunset in December of 2025. And so we're going to go to, between now and then, we're going to have some type of tax overhaul. And taxes aren't going to go down, Peter. We're at the lowest tax brackets in history. Taxes have to go up with the debt that the country has and with the amount of money we're giving away and the amount of money that we've infused into our economy since 2020. We have to get more money to pay for that. And so taxes are going to go up. Now is the time to sit down and really plan. And if you're prior to 65 going on Medicare, it's even more important because there's a lot more things that we can do with the Roth conversions and pay the taxes now. Yeah. I think it's a situation, Peter, of do I want to pay taxes on what I put into my account, or do I want to pay taxes on what I put into it, plus all the gains for the years that I held it? So I have a much bigger thing. It's kind of like the tax on the seed or the harvest, which is better for us. And I think in our case, as much as we can tax that seed, the lower our taxes are going to be.
So if we've already built up a large tax deferred balance, John, it doesn't sound like that was necessarily wrong to do. It's just that now is the window of opportunity maybe to be proactive in managing that tax bill that we will ultimately pay.
Yeah, I don't know why our society feels like that we have to pay taxes, so there's nothing we can do about it. I mean, you don't have to be rich to do tax planning. Tax planning is looking ahead. Tax preparation is looking at what I did in 2022 now, and then paying the taxes that I owe or getting a refund. Looking forward, what am I going to do in 2023, 2024, and the rest of my retirement? How am I going to manage my taxes? That's tax planning.
Well, you've got a list of several reasons why to consider a Roth IRA now, or Roth conversions. Today's historically low income tax rates, you've mentioned that, but along with the expiration of that Tax Cuts and Jobs Act, the potential for AMT, alternative minimum tax, as well as estate tax levels also change with that expiration. A little bit of a gray cloud, but a silver lining, the depreciated portfolio value, John. The volatility that we've seen in the market may be another reason to consider Roths and possible elimination of the Roth opportunity into the future. So all of these, as well as legacy planning and avoiding or controlling those required minimum distributions into the future, these are reasons why now is the opportune moment to consider these Roth opportunities.
Well, that's right. A lot of people have lost 20, 30% in their portfolios. And so now's a great time to take advantage of that and then build on that and go ahead and pay the taxes on the lower amount. And let's get that conversion done. I mean, that there's certainly a lot of advantages to do the Roth. And it's something that we're planning. In fact, as you know, in the new Secure Act 2.0, 401ks now have an obligation to put a Roth plan in every 401k that's coming out.
And by the way, ladies and gentlemen, there is a great report on that Secure Act 2.0 and the fact that John just mentioned, as well as many other need-to-know aspects of one of the most sweeping legislative changes to our retirement accounts and rules and laws that govern them. A report on the website GulfCoastFinancial.net. GulfCoastFinancial.net is an excellent report. Definitely worth reviewing that. But John, bottom line, it is a pay me now or pay me later. And if we continue to defer, on one hand, that seems like a good thing because we don't have to pay now, but it might mean more later. And in fact, I think the IRS is on to this as they continue to delay the required minimum distributions. That's kind of the headline. But many people could be delaying those into that environment where we are paying higher tax rates and brackets.
Well, yeah, we're paying, and it eliminates our ability to do a lot of tax planning. And as you know, our Medicare Part B is indexed on income. Our amount of taxes we pay on Social Security is based on our income. So the more we have to take those required minimum distributions out, the more we have to pay taxes, of course, on a lot of different things. And Peter, we've talked on this show about the fact that I really believe that Social Security payments in the future are going to be indexed for income. The more we make, the less we're going to get. And so I can see us having to do those required minimum distributions and it putting us in a income bracket that's going to be a lower Social Security payment. There are a lot of things planned, I'm sure, that we don't know about that we could take a lot of advantage of by doing life insurance and doing these Roth IRA conversions.
So there are opportunities to be proactive in managing our tax liability, John. And as we are in that time of year, getting down to crunch time here, but tax season, a lot of people are thinking kind of retroactively about last year's tax bill. We need to change that paradigm, be more proactive, thinking about next year and all of the next years ahead tax bill and how to control it.
That's right. And there are some things that we can do right now, Peter. I mean, right now, as we go through our taxes with our clients, we're seeing opportunities for the charitable distributions. If you're over 70 and a half, you can give money out of your deferred account to a qualified charity. It has to go directly from the account to the charity. You can't handle it. And it counts for the required minimum distribution. And it passes tax-free. So with a large standard deduction that we have right now, very few people who are retired are getting the benefit of charitable contributions. So why not take it out and not have to pay taxes on it, but also let it lower your required minimum distribution if you're in that phase of life. Also, we can do life insurance. Life insurance, people are writing life insurance now into the 60s, 70s, and it's a great way to pass an inheritance tax-free, but it also builds tax-free income. So we can use those required minimum distributions to buy life insurance. And one that we haven't talked about on this show and we haven't really discussed a lot is the qualified longevity annuity contract. The Secure Act 2.0 just increased that to $200,000. So I can take $200,000 of my IRA, put it into this qualified longevity annuity contract, and it takes it away from my income tax, my required minimum distribution. But at the same time, it will build me a lifetime income that I can turn on later, and the will pass to the kids or to your beneficiaries. So it's a great way to do that. We don't talk about that, but now that we're up to the 200,000 limit per person, we're getting a lot more that we can do with it than what we could do prior.
John, do you find that a lot of savers and investors have actually taken the time working maybe with a planner or advisor to quantify and truly understand how much they are likely to pay in taxes into the future?
No, Peter, I really don't. I don't think people, they plan when they talk to us, they want to know how much am I going to pay next year. It's not like how much am I going to pay in the future. If you looked at the numbers and saw how much of your, just on today's tax bracket, which are the lowest in history, if you looked how much you owed the government, on $1 million, you could owe them as much as 300,000+ of that money. It's really not yours. You could have $1 million contract, but it's not yours. It's not you because you still owe the government for the taxes on that money.
And I know that you've talked about before the kind of levels of taxation, taxes on income, taxes on assets and investments, and taxes on estates. And where our dollars are going to determine a large amount of how much tax we ultimately pay, as well as the order of operations and how we access those different levels.
Well, that's right. And also don't forget that the way that the Secure Act has placed these things is the beneficiaries that receive our money that's been deferred all these years, they have to take it out over 10 years. And so they're going to pay the taxes. It's going to affect their taxes. And so they could be in retirement and all of a sudden they've got this extra income coming in, which isn't bad. It's just that it creates a tax bill for them. And at the same time, there are things that we could have done to change that. Also, if I'm doing a distribution, a required distribution, my beneficiaries have to continue that distribution for 10 years. And then at the end of the 10th year, take out the balance. So they don't even have the option of waiting and deferring it the whole 10 years and then pulling it out. A lot of things interact here and make it really difficult, not only for us, but also for our beneficiaries.
Well, I'm hearing the voices in my head, John. Well, if I'm leaving money to them, then I don't care. That's their problem to deal with the tax bill. But I don't think most people want to leave the largest amount possible to the IRS in any set of circumstances. And oftentimes, I think across the board, we can reduce the total amount that we pay if we are proactive in planning. And John, I know that you crunch those numbers and show people kind of side-by-side comparisons a lot of times there.
Well, we do tax planning. We have the software, we have the people on staff, and we do tax planning, trying to give you the lowest tax bracket. Also, don't forget the way that we take the money out of our accounts also creates taxes. So we look at how we're going to distribute our assets during retirement so that we can get the best potential outcome tax-wise.
And John, it's not what you make, it's what you keep, it's what you get to spend out of it. And I know that's a big part of the financial focus written plan, the retirement income planning process that you have there at GulfCoast Financial Services.
We look at that with every plan, Peter. That's one of the things that we're really proactive about, is we want to make sure that that's a holistic approach to everything that someone's going to run into in retirement: Social Security, Medicare, taxes, all the different things, asset accumulation. We look at all of that into that one plan and try to do the best job we can to show them where they are in plain English and let them know what we can do so that we can make some changes to their portfolio and the way they're saving money.
We'll get that financial focus plan in your hands, ladies and gentlemen, to help be more efficient, control, reduce, eliminate unnecessary taxes in 2023 and beyond. That is what they strive to help their clients accomplish there at Gulf Coast Financial Services. And John, we always appreciate your time here on the program, your insight and pointing these things out that we need to be paying attention to with our money.
Well, thank you, Peter. It's great to be here, and I hope you have a good week.
Again, ladies and gentlemen, if you would like that complimentary review process to get that financially focused plan, pick up the phone, give Gulf Coast Financial Services and John Kuykendall a call, 386-755-9018, 386-755-9018, or visit online where you can download the report on the Secure Act or request the time for the complimentary planning review strategy session, that written financial focused plan. GulfCoastFinancial.net, GulfCoastFinancial.net, or again, pick up the phone, give a call, 386-755-9018. John, always a pleasure.
Thank you, Peter. Great to be here.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities, Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services, Inc., a registered investment advisor in Florida. Gulf Coast Financial Services, Inc. is not affiliated with Kovac Securities, Inc. or Kovac Advisors, Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.